They don't want you to see this, 32%. That's how much silver crashed in just days after touching an all-time record of $121 per ounce. And while mainstream media called it a healthy correction, I'm going to show you exactly who pulled the trigger, why they did it, and how the same playbook that crushed silver in 1980 and 2011 just got deployed again in 2026. The margin hike that triggered this crash wasn't random. It wasn't routine risk management. It was a precision strike designed to liquidate billions in leveraged positions at the exact moment silver threatened to break free from paper market control. And here's what they're not telling you. While retail traders were getting margin called into oblivion, someone was accumulating physical metal at a massive discount. By the end of this video, you'll know exactly who benefits from these crashes, why the fundamentals are actually stronger now than before the sell-off, and what the smartest money in the world is doing right now while everyone else panics. If you want to stay ahead of these moves instead of being a victim of them, hit subscribe right now. This channel exists to expose what Wall Street would rather you never understand. Let's break down exactly what happened. As of February 10th, 2026, silver is trading at $81.95 per ounce according to Priority Gold. That represents a 7.07% bounce from the previous day, and despite the recent chaos, silver is still 160% higher than it was just 1 year ago. So before anyone tells you this rally is over, understand the context. 1 year ago today, silver was trading at just $32.30 per ounce. Even after this brutal correction, you're looking at gains that most asset classes dream about. But here's where it gets interesting. U.S. Treasury Secretary Scott Bessent attributed last week's extreme swings in precious metals to Chinese traders, describing the recent top as a speculative blow-off. A wave of buying from Chinese speculators, from individual investors to large equity funds venturing into commodities, lifted metals from copper to silver to fresh records over the past month. A massive premium for China's only pure-play silver fund even prompted the issuer to send out near-daily risk warnings and halt subscriptions. So what actually triggered the collapse? CME lifted initial margin requirements again for key precious metals contracts. COMEX 5,000 silver futures initial margin was raised to 18% from 15%. This latest adjustment followed a broader margin increase announced on January 31st, when CME raised margins on COMEX gold and silver futures due to sharp price swings. Silver's recent rally faced a sharp correction after CME Group raised margin requirements by 30% overall, triggering forced liquidations and a 17% price drop. Let me explain why this matters in plain English. When you trade silver futures, you don't pay the full contract value up front. You post margin, essentially a deposit. Higher margins typically cool speculative positioning near term, but they can also amplify selling pressure if traders must cut positions to meet calls. For markets, the immediate impact is usually mechanical. Higher margins increase the cost of carrying exposure, which can reduce speculative participation and prompt some holders to trim positions. That dynamic can be destabilizing in the very short term if traders are forced to sell to meet higher collateral requirements, particularly in thin liquidity conditions. The timing is crucial here. CME Group announced the increase in margin requirements following a significant price drop in these commodities. The adjustments are part of CME Group's routine market volatility assessments to ensure adequate collateral coverage. Whether you believe this is standard risk management or something more deliberate, the effect was devastating for leveraged traders. When volatility rises, market makers naturally widen spreads and reduce balance sheet usage, leaving liquidity weakest precisely when it is needed most, said Ole Hansen, head of commodity strategy at Saxo Bank. Measures of historic volatility have surged, and the market hasn't seen this much turmoil since 1980. Metals Daily Chief Executive Officer Ross Norman noted that speculation, particularly in China, is wreaking havoc on the price discovery process for bullion. Volatility in precious metals has become self-sustaining, he said, removed from the real market and its drivers. Now here's where this gets really important. The underlying fundamentals haven't changed. In fact, they've strengthened. On January 1st, 2026, China designated silver as a strategic resource alongside rare earth minerals. The move restricts silver exports, requiring licenses that have become harder to get. Only 44 companies qualified for silver export licenses as China seeks to guarantee supply for next-gen solar, EVs, and electronics technologies. Silver's strategic importance lies in its central role across modern industries. Although China accounts for only about 13% of global mined silver, it dominates 60 to 70% of global refining, giving it outsized influence over downstream supply chains. China's newly implemented rules replace a quota-based regime in place since 2000 with a stringent export licensing system. Only 44 large, state-approved entities, each with annual production above 80 tons and substantial financial reserves, are allowed to export silver. This policy culls hundreds of smaller independent exporters, many of whom were key suppliers to silver refiners and industrial users worldwide. Elon Musk responded to news of the restrictions saying, "This is not good. Silver is needed in many industrial processes." The supply picture is becoming critical. For the past 5 consecutive years, global demand has exceeded total supply, creating a structural deficit that has quietly eroded inventories across the world. In 2025, global silver demand reached an estimated 1.24 billion ounces, while total supply, including mine production and recycling, only amounted to about 1.01 billion ounces. COMEX registered inventories in the United States are down nearly 70% since 2020. London Bullion Market Association vaults have lost around 40% of their holdings. Shanghai inventories have fallen to their lowest level in a decade. Silver inventories in Shanghai Futures Exchange warehouses have plunged to 715 tons. This is the lowest level since July 2016. That marks an 86% collapse from the 2020 pandemic peak. What do the experts see ahead? TD Securities has an average annual price target for silver at $65.50 per ounce, with a 2026 high of $118 per ounce. In January, Citigroup revised its silver price forecast higher, expecting silver prices to reach a record $150 per ounce within 3 months. Gold Silver's lead analyst Alan Hibbard stated, "I'm expecting silver to perform better in 2026 than it did in 2025, which saw 147% gains. I wouldn't be surprised to see the price of silver increase by over $100 per ounce to 175 plus." Anthony Milewski, senior analyst at the Oregon Group, noted, "Silver fundamentals today look materially different than in past cycles. While a $150 silver price is an aggressive scenario, the combination of constrained supply, industrial demand growth, and macroeconomic uncertainty makes it worth serious consideration." But I want to be honest with you about the risks. Former JPMorgan strategist Marko Kolanovic delivered a blunt silver forecast, saying the rally faces existential risks that will eventually lead to a bubble burst. Unlike purely fictitious assets like NFTs, bubbles in commodities can't last long. Industry demand dries up, supply, including recycling, increases, and new production is hedged. Julius Baer analysts have pointed to softer industrial demand, including from solar panel manufacturers, and weaker jewelry demand, which could limit the scope for a sustained rebound. If industrial demand slows and real yields rise again, silver could either stabilize or retreat from current price levels, says Henry Yoshida, CFP, CEO and co-founder of Rocket Dollar. Looking at the technical picture, based on the latest market data, silver's strong bullish momentum sets the initial technical support for 2026 in the range of $65 to $70, higher than previous conservative estimates. Markets Live strategist Mark Cranfield noted, "Traders will be watching for this week's nadir just above $71, but arguably more significant is the $70 mark." In general, there are 3 main scenarios for silver price movements in 2026. In a bullish scenario, a combination of strong fundamentals, high industrial demand, and positive market sentiment could push silver prices to $85 to $90 per ounce. A moderate or base case scenario projects prices in the $70 to $80 range, consistent with stable demand trends and ongoing supply deficits. A bearish scenario remains possible if the US dollar strengthens or investors shift their focus to high-yield assets, causing silver prices to drop to the $60 to $70 per ounce range. The recovery this week was driven by easing U.S. inflation expectations, softer real yields, and a weaker dollar ahead of key U.S. labor and CPI releases that could reinforce expectations for Federal Reserve easing later this year. Central bank activity remains a pillar of support, with the World Gold Council reporting that sovereign institutions added 230 tons of bullion in the fourth quarter of 2025 alone. This institutional floor, combined with emergency CME margin hikes that flushed out speculative paper leverage, has created what some call a high-conviction entry point for physical stackers looking to secure metal before the next supply squeeze. So what's my take? I see this correction as violent, but ultimately healthy for the long-term bull case. The fundamental drivers haven't disappeared. China's export restrictions remain in place. Industrial demand from solar, EVs, and AI infrastructure continues accelerating. The 5-year supply deficit isn't going away overnight. Historical margin hikes have marked major silver tops, but analysts like those at Seeking Alpha expect this episode to be a temporary setback, not a long-term reversal. Strong long-term demand drivers, including energy transition, tech adoption, supply deficits, and inflation hedging, support a continued bullish thesis for silver. For those considering action, think about the $70 level as critical support. If silver holds above that zone, the bull case remains intact. If it breaks meaningfully lower, we could see a deeper correction towards $60 before the next leg higher. Advisors typically advise allocating no more than 10 to 15% to silver and capping precious metal exposure overall at 20%. As ZGA Wu, an analyst at Jinrui Futures, noted, longs are stopping out and shorts are taking profits. Investors also tend to keep holdings light ahead of the week-long Lunar New Year break, which begins on February 16th. That could create additional near-term volatility. I want to hear from you. Are you buying this dip, or are you waiting for further confirmation that the bottom is in? Drop your thoughts in the comments below. I read every single one, and it helps shape future content on this channel. While over time, silver prices tend to only increase like gold, many experts do anticipate that it will eventually march toward $200 per ounce. Whether that happens in 2026 or takes longer depends on factors we can't fully predict. If you found this analysis valuable, make sure you're subscribed and have notifications turned on. Major moves in silver demand real-time coverage, and that's exactly what this channel delivers. The volatility we've seen is likely not over. The last time silver experienced a move of this magnitude was in March 2020 during the COVID crash. All signs suggest volatility is likely to remain elevated in the near term. Stay informed, stay patient, and remember, nothing in this video constitutes financial advice. Always do your own research and consult qualified professionals before making investment decisions. I'll see you in the next one.